Holly, let's talk about active ETFs. Inflows into ETFs have been, let's just say, below average so far this year. But active ETFs are getting more than their fair share. Most inflows into ETFs, still into passive, folks. You ought to know that. So this passive is index funds like the S&P 500. But so far this year, I see 22% of the $289 billion in inflows into ETFs has gone into actively managed funds. And folks, those who don't know, that's a lot for actively managed. That's a big share. Including several of the funds that Holly's running here. So Holly, and here's the screen here, why is active getting a larger share of the inflows this year? What's going on with this?
Yeah, thank you so much for asking, Bob. You're right. Active ETFs represent 6% of the total assets under management within the ETF vehicle today, and yet are receiving 22% of flows on a year-to-date basis. So that is very disproportionate. I think it's a function of where investors are choosing to place their money and where we would expect to see that moving forward. The ETF is gaining share on the mutual fund as a vehicle by about 1 to 3 percentage points per year, and yet 70% of the total fund assets remain in mutual funds, a majority of which is actively managed. So we find it very difficult to be bullish on the growth of the ETF vehicle and not be simultaneously bullish on the growth of active management. In particular, active management that can deliver on long-term superior results like the funds we've brought to market have.
Well, but the point being here, is it because most of the assets in passive are slowly, we know people are still taking money and putting it into passive ETFs, yet active's been a very small group. We've seen people moving money over, as you have, from mutual funds into ETFs in one group, and then there are people starting new actively managed ones. In one sense, it's a sort of natural evolution, isn't it, Holly, for ETFs? I mean, active is a part of the whole mutual fund industry. Why wouldn't it be a part of the ETF industry, I guess?
I think you're spot on there, Bob. I mean, in 2019, when the SEC passed Rule 6c11, which allowed active managers to bring their strategies into the ETF vehicle with the same layer of tax efficiency, it really opened the door for firms like Capital Group to get into this space in a meaningful way. Investors have long committed assets to active management. We believe that our legacy of delivering on superior long-term results for clients is one that clients want to continue to invest in, and we're really interested in bringing our investment services in all of the vehicles that can serve their variety of needs. In particular, for advisory models and for taxable assets, the ETF can be a really efficient way to consider investing.
So Capital Group, it's a big company, folks. They managed about $2 trillion, but you got into ETFs relatively late, as I recall. I think there's $12 billion in ETF assets since you launched your first funds back in February of 2022. But you keep expanding. I see last week 5 new funds, including a multi-asset fund. This is a core balance fund. That's what they call it, folks. So why the need to keep expanding here? And here's the list of the 5 new ones that we're putting up here for you.
Yeah, thank you so much. You are right. Last week, we expanded our suite. We now have 14 ETFs in the market, just under $13.5 billion in assets under management. And the growth that we've seen in just a little over 18 months' time is really quite tremendous. We think it's a testament to the fact that we have brought products to market that our clients have specifically asked for, focused on major asset allocation categories and giving all the building block pieces to really construct a holistic portfolio. And so when you step back and you look at one of the categories that has been the most requested by our clients, it has been multi-asset. Multi-asset's not typically a space where ETFs have thrived, but Capital Group manages $500 billion in multi-asset funds. So we believe that the fund that we brought to market last week, CGBL, will deliver our best thinking in balanced services in the vehicle that our clients are increasingly demanding.
So this is this balance fund, Rick. I want you to respond to talk about 60-40. You're an old 60-45. The balance fund Holly's talking about is a core allocation, 60% stocks, 40% bonds, with the equity side being made up of individual securities and the bond side with fixed income ETFs. You've been in this business a long time. Your thoughts on active management, whether it's in a mutual fund wrapper or an ETF wrapper?
I think in most asset classes, there's no reason for active. For example, if you're going to buy the S&P 500, you're going to buy the biggest stocks, the S&P 500 index, check the box, call it a day. But on the other hand, international, emerging markets, and other categories like that, active can make sense because those markets are small, they are very divisive, and you could benefit from an active manager.
And we have the bond guys go nuts on Alex. Oh, Bob, you see what happened this year? You see how quickly things move? Active can do this. We hear this all the time from Active, but is there something to be said
It depends on the nature. The bond market is itself very diverse, whether you're dealing with the governments or corporates, whether you're dealing with high quality versus high yield, U.S. versus foreign, so it really depends. I find it really interesting. Of the 5 new ETFs that Capital Group launched this week, 3 of them are income oriented.
Yeah.
And that's telling you really where the market is paying attention.
I think so. Holly, you've got a large suite of actively managed and equity and fixed income ETFs. Where are you seeing the most activity right now? Where's the flows? As Rick said, you've got a large group of active and fixed income, but fixed income is where some of the flows are right now, I would gather.
Yeah, so we're really seeing even flows across the suite, which makes us incredibly pleased because that tells us that our clients really are looking at long-term allocations in their portfolio and not trying to chase the current hot dot. The fastest growing of the suite of funds that we launched originally back in February of 22 is CGDV, which is a dividend value ETF. It's intended to be value oriented, but focusing on higher quality companies, and in particular those that are delivering income in a portfolio. Income has been a theme that our clients have been very interested in this environment and in this interest rate environment. But really, again, I would just say all of the funds that we launched last February have over $1 billion individually, and that tells us that growth is widespread regardless of the asset class. And
you know, you're famous, of course, from the American funds, and that's an actively managed. In the ETF wrapper, the fees are lower, right? Tell us what the fees are for these 5 new ones that you just launched.
Well, I would say across all of our ETFs, we are pricing our mutual funds and our sort of lowest cost mutual fund share class and our ETF really in line with each other, because at the end of the day, as an organization, we are committed to delivering great value for investment. And we are committed to delivering low cost services to the market for our investors. And we've carried that same philosophy over to our ETFs. So when looking across available options in the mutual fund franchise or the ETF franchise, you will see very similar price points. Importantly, all of the ETFs that we have in market today are at or near the lowest quartile among other active ETFs. So we really believe that we're priced competitively at the rate that we deliver services to market today.
I want to ask your thoughts on stocks versus bonds. We talk about 60-40 stock bond portfolio, and we're in this very unusual position once again. Stocks down, bonds down. This happened in parts of 2022, and people were just shocked. They hadn't seen it since 15 years.
Right.
So what are you telling clients now about this? I mean, I'm a baby boomer. I've always said, here I am. I'm 67 years old. Friends of mine say, Bob, stocks down and bonds down again this year, even if it's only a little part of the year. We can't stand another 20% down year like last year in stocks, and bonds down again.
And the laundry list of reasons to be negative are pretty high. What's going on in real estate, what's happening with interest rates, what's happening with government shutdown coming, with the absence of a Speaker of the House, the horrific events in the Middle East this past weekend. The list goes on and on and on, let alone, you know, Ukraine and Russia, China and Japan and South Korea. We've got a lot of issues going on. So it's easy to be negative. And that could cause you to say, why do I want to put myself in a position of maybe losing another 20 or 30% of my money when I've already amassed an awful lot of money and I'm already in my 60s or 70s and I need the safety and protection. And by the way, I can get 5% in my bonds or U.S. Treasury or my bank CD. Why don't I just park it, earn 5%, call it a day, and go watch HBO?
Yeah.
There are 2 schools of thought. One is, go ahead and do that. Why take risk if you don't need to take risk? You've spent your career, the last 40 years, accumulating assets. You've been climbing a mountain, building wealth. Congratulations, you're now at the top of the mountain. Once you're at the top, stop climbing, or you just fall over the other side.
What's the advice of stop climbing? You mean, are you saying convert more money to cash, or just stay there?
Increase your allocation to short-term securities that are going to pay 4 or 5% in interest these days.
Well, let me just push back against that. I'm 67. I'm planning to live at least until 90. In fact, you were one of the people for years kept saying, I kept thinking, folks, that I was going to die at 85. And Rick, who's an old friend of mine for years, said, Bob, you're wrong. You're going to live to 90, and you should even work on 95. But that means that if we're down this year, it's not going to matter in 20 years.
That's the other school of thought.
So why don't we just stay in my allocation now? Why should I move more towards short-term?
I prefer that viewpoint. However, it comes down to behavioral finance. It comes down to human emotion. Do you have the stomach Does your spouse have the stomach to hang in there if things get ugly like they did in 01, 08, 2020? Can you hang in there? You should. And if you have ample enough cash reserves and a stable income stream, that helps you hang in there. But if emotionally you're not going to be able to cut it, if you panicked this morning over this past weekend, I don't know if you're going to be able to handle the market downturn. So if you can handle it, you're right. Plan on living to 95 or 100, and if you're 65 today, you got 30 years to go.
It's a long ways.
Exactly. But if you can't handle it emotionally, then take some chips off the table. Go safety, even if it's less profitable, even if it exposes you to inflation and taxes, you'll sleep better at night.
Holly, are the flows in your... Go ahead, Holly.
I was going to say, I do think, though, it's important for us to realize that there are $6 trillion of cash sitting on the sidelines today. That's 2 to 3 times what you normally see as the baseline for cash on the sidelines. And when cash rates peak or have been at elevated rates for a long time, you tend to see reinvestment in the market. And so we think we could see $1 trillion come into the bond market alone over the next few years as cash comes off the sidelines. And so we really think that there's a lot of opportunity for investors to consider putting more money to work in the environment that we're in today, despite the uncertainty, because as you both have been talking about, we're talking about the long term here. I mean, a 30-year investment horizon is a long time to leave money on the table.
And that is a completely logical and accurate statement. I agree with Holly. But I'm not sure everybody who's in the investing world is acting logically as opposed to emotionally. You got to know yourself.
You mean people act irrationally? If this gets out, we could start a whole new school called behavioral economics. Just think about this. Holly, where are the flows going in fixed income? I mean, are you seeing people throw money in short-term muni bond funds, or what, anything stick out to you?
Yeah, so we are seeing increased interest in short duration fixed income. So CGSD is the fund that we recently launched in that space. And it's certainly an area where we're seeing enough interest, in part because, as you highlighted, interest rates are quite high, even with very little duration risk on the table. But additionally, we're seeing a lot of demand for core bond and core plus fixed income. CGCP was among the original 6 funds that we launched, again, over $1 billion in assets, and continues to grow. So really, we're seeing interest among our client base, who tend to be a bit longer term oriented in nature, across the full spectrum, but certainly a lot of conversations in the short duration space, given the environment that we're in.
What else is out there for Capital Group in terms of, I mean, I'm not asking you to give away what your next 6 months is going to look like, but is there gaps in your coverage right now that you want? You covered the basic universe that you've already got going here. What else? What opportunities exist for you out there?
Well, I mean, we think we have a lot of opportunities to be a meaningful player in a continually growing active ETF environment. As we think about, our asset allocation services, as I mentioned, we manage $500 billion in multi-asset funds today. We just launched our first. I could envision a world where there are multiple behind that. As we think about bringing our best-in-class international investing capabilities into the ETF vehicle, we have a few offerings in that space today. I would imagine there is plenty more white space for us to continue to participate. And at the end of the day, our focus is really about being responsive to investor and client needs. So what we've been focused on to date is bringing out core building blocks that can ultimately lead to a model portfolio solution, because we know a majority of our clients are asking for all ETF models and are really looking for active management in that space. So that's where our near-term focus has been. And as we look even further out, we plan to continue to be responsive to client needs and bring our best-in-class investment services into this vehicle.